As time goes on, real estate is only getting more unaffordable. But what if I told you that you could invest in real estate today without spending thousands of dollars on a down payment or hundreds of hours on fixing toilets and water leaks? Well, in this video, I'm going to show you exactly how you can do that by investing in REITs. REIT stands for Real Estate Investment Trust, and these are companies that own, operate, or finance income-generating real estate. Their business model is pretty simple. REITs pool the money of a bunch of outside investors and use it to invest in real estate. In most cases, REITs are publicly traded, so they get their outside investors by selling their stock in the stock market. They then use these funds to buy real estate to then own, operate, and improve. REITs buy all different kinds of real estate. Whatever type of real estate you can think of, there's probably a REIT out there that specializes in that. There are REITs that buy residential real estate like apartment complexes, mobile home parks, or single-family homes. Some REITs own retail space like shopping malls, strip malls, or storefronts. There's REITs for industry-specific real estate like medical facilities or data centers. Some REITs don't even buy buildings. There's REITs out there that buy things like timberland or infrastructure, and there are even REITs that don't buy real estate at all. About 10% of REITs out there are in mortgages rather than the real estate itself. Investing in REITs are like investing in stocks and ETFs. You can buy and sell shares on the stock market through a broker. But when buying REITs, just like with stocks, you want to make sure you stick to what you know and you know what you're buying. When analyzing a REIT investment, it's important to assess a few things. First, the history of returns. The way REITs provide returns is through high dividend payouts and modest long-term appreciation. So look for companies that have a long history of providing both. You want REITs that consistently grow their dividend payouts while still modestly growing in value. Next, take a look at their management team. Strong management makes a huge difference in any company, so you really want to make sure the company has been around for a long time and that the leadership running the REIT has a lot of experience in their space. Finally, you want to make sure the assets that the REIT owns and operates are high quality. If you own real estate, would you rather own a property in the best parts of your town with tenants that have no issue paying rent every month? Or a property in a dead part of town with tenants that are consistently telling you that they'll have their rent next week when they're already 5 months overdue? Quality matters in real estate, and that includes REITs. So do your homework on the philosophy that the REIT invests with to make sure it aligns with what you're looking for in your portfolio. Now, before we get into the pros and cons of investing in REITs, if you're finding this video helpful so far, don't forget to toss it a like and subscribe to my channel for more videos like this one. My channel is pretty new, so your subscription goes a really long way for helping other people who need this information find it too. With that out of the way, let's get into the pros and cons of investing in REITs. The first pro is the high dividends that REITs typically pay out. By law, a REIT has to hit certain requirements to qualify as a REIT. And these are mostly requirements that ensure the REIT actually invests the funds in real estate. But as an investor, the most important one to note is that REITs must pay out a minimum of 90% of their taxable income to shareholders as dividends every year. Because of this requirement, REITs make for great income-producing investments because they're required to pay out the profits they earn from rental income or whatever income they earn straight to their investors. But since that only leaves them 10% of their income to buy new or improve existing properties, a con is that they tend to appreciate in value slower than other asset classes since they don't really have as much money left over to grow their business with. On top of that, another con is that those dividends you get from REITs usually don't qualify as qualified dividends. This means that instead of paying a favorable dividend tax rate that gets no higher than 20%, you need to treat dividends from REITs as regular income and pay up to 37% in taxes. That being said, if you use a tax advantage account to invest in REITs, like an HSA or Roth IRA, then you can avoid these taxes altogether. And if you're interested in learning more about how you can avoid taxes on dividends and stocks, check out my video on taxes on stocks linked in the description. Another pro of investing in REITs is the low-cost exposure it can give you to real estate. REITs are truly a passive investment. You don't need to spend time dealing with clogged toilets or water leaks like a landlord does, but you still get the benefits of the rental income the REIT earns each month. And on top of that time it saves you, most people don't have the money to go out and buy an apartment complex, but REITs give you the ability to get a piece of one and reap the benefits of owning that for as little or as much as you want to invest. That being said, a con to investing in REITs, like most real estate, is the sensitivity to interest rates. Most REITs don't buy real estate like you or I would buy a house. If you were buying a house, you'd typically go for a 30-year fixed mortgage, which means that your interest rate on that mortgage would be locked in for 30 years. But bigger real estate that REITs buy is typically financed with what's called adjustable rate mortgages, meaning as interest rates go down, the interest owed on that mortgage adjusts down, but when interest rate goes up, that interest expense adjusts up. Because of this, when interest rates go up, it can be really bad for REITs because it means that their cost to owning the real estate they own also goes up, thus meaning less profits for you as an investor. Now, one last pro of a REIT investment is the liquidity aspect. If you own a house and you wanted to sell it, it would probably take you over a month to find a buyer, go through the selling and closing process, and ultimately get money for it. But with REITs, since you just invest in shares of REITs through the stock market, if you ever wanted to sell, it's as easy as selling in your brokerage account, which you could do in a matter of minutes. So all in all, REITs are a low cost and passive way to invest in real estate of all different kinds that you might not have access to otherwise. But like any investment, they do come with risks, so it's important to do your research before putting any money down. So with that, thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button to see more videos like this one.